Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, it is not a secret higher interest rates lead to higher costs of capital for governments and companies. For example, the U.S. government interest payments per day, and you're sitting down so you're not going to fall over.
Per day.
Per day, have doubled from $1 billion per day pre-pandemic to almost $2 billion per day in 2023.
Course of 3 years.
Yeah, that's a big number, which makes people wonder, can the Fed really stick with higher rates for longer?
It's obviously an interesting dynamic, Steve, but looking at the FOMC members' projections, that's the Federal Open Market Committee.
3 times fast.
Yeah, these are the people that vote on interest rates. Their projections for the long run Fed funds rate continues to march higher. It's not leveling off. So that implies that perhaps a new rate regime is here to stay, which obviously will lead to issues for over-leveraged companies that have maturing debt over the next few years. In particular, high-yield bonds and leveraged loans have a debt maturity wall coming due over the next few years that could lead to trouble should interest rates persistently remain higher. That's refinancing that debt's going to be tough.
It is, and to that point, Travis, in the high yield, we're starting to see defaults tick higher.
Yeah.
But spreads, the extra interest investors earn for taking more credit risk, aren't widening out to reflect the extra risk the investors are taking.
Yeah, you should, if defaults are ticking up, you should expect markets to get nervous. But so there's a couple of theories on why spreads aren't widening here, Steve. One, markets just anticipate that defaults are going to taper off here in the future, that things are going to get back on track and there's no real risk developing.
We'll see.
Or two, high yield markets expect the Fed to come to the rescue should the situation start to deteriorate.
They always have in the past.
As we saw in 2020 and the recent regional bank scare, I'm going to call it. Either way, in today's credit markets, quality matters, and investors should be aware of the types of bonds they own in their portfolios because they're primed to play a bigger role, but know what you own here.
So true, Travis. It's been great. I look forward to it next week.
Look forward to it as well.